There are moments in history when the change is so large that most people cannot see it while they are living through it. They see the headlines, they see oil prices moving, they see the dollar weakening, they see China gaining ground, they see a few warnings from major banks, but they do not connect those things into one system. That is the mistake, in my experience. The big shifts that matter most are rarely isolated events. They are usually parts of a larger machine. One part moves, then another part moves, then another. And by the time most people understand what happened, the price of protection has already gone up. That is what I believe is happening now. The United States dollar is having one of its worst periods in more than half a century. Oil prices are rising in a way that increases the risk of inflation staying higher for longer. The possibility of stagflation is no longer a theoretical discussion for economists. It is becoming a real pressure in the system, and at the same time, the United States is beginning to lose some of the trade dominance that it held for most of the modern financial era. That does not mean the United States is collapsing tomorrow. That does not mean the dollar disappears. That does not mean a rational investor should panic, sell everything, and run into whatever asset has the loudest headline this week. It means something more important. It means the global balance of power, trade, money, and investment returns is shifting. When a shift like that begins, the people who understand the structure can adapt. The people who only watch the headlines usually react too late. So the question is not whether the world is changing. The question is whether your portfolio is built for a world that already exists or for a world that is slowly disappearing. That is the distinction that matters. For most of the last several decades, the average American investor could make a very simple assumption. If you owned enough of the United States market and you stayed invested long enough, the odds were very much in your favor. That assumption worked because the United States sat at the center of the global economic machine after World War II. The United States did not simply win a military conflict. It won the financial architecture that followed it. The dollar became the world's reserve currency. Countries needed dollars to buy oil. They needed dollars to settle debts. They needed dollars to conduct trade. They needed dollars because the system was built around dollars. That gave the United States what economists call an exorbitant privilege. It allowed America to borrow cheaply. It allowed America to run large deficits. It allowed America to print money in ways other countries could not. It allowed America to be more reckless than other countries because other countries still needed dollars, held dollars, and invested their savings back into the American system. That is a very powerful position to be in. But every powerful position has a cycle. A reserve currency is not just a piece of paper or an entry in a bank account. It is trust, it is liquidity, it is military power, it is financial infrastructure, it is the belief that holding that currency is safer than holding alternatives. When that belief is very strong, the system reinforces itself. When that belief weakens, even gradually, the system also changes gradually. Then suddenly, that is what most people miss. They think a reserve currency either dominates or collapses. That is not usually how these things work. More often, the currency slowly loses share. Countries diversify, payment systems multiply. Trade routes change, central banks adjust. Commodities are priced differently. Capital begins to look for new places to go. And then investors who assumed the old world would last forever discover that they were overexposed to one country, one currency, and one set of assumptions. This is why the changing world order matters. I know that phrase can sound dramatic. Many people use it carelessly, but the idea behind it is very real. Over long periods of time, the relative power of countries changes. Debt levels change, productivity changes, military strength changes, internal conflict changes, education changes, innovation changes, capital flows change. When those things move together, the financial world changes with them. Right now, by many measurable signs, we are in the middle of such a shift. The group of countries often referred to as BRICS, including China, Russia, India, Brazil, South Africa, and others around that orbit, now represents a very large share of global output when measured by purchasing power. The Western alliance that built much of the post-war financial order is still extremely powerful, but it no longer controls the same share of global economic growth that it once did. That matters. It matters because money follows growth. It matters because political power follows economic power. It matters because countries that become larger want more control over the financial rails they use. It matters because a country that depends completely on another country's currency also depends on that country's rules. And when countries believe those rules can be used against them, they begin building alternatives. That is what the de-dollarization process is really about. It is not one dramatic meeting where countries decide to abandon the dollar overnight. It is a playbook. It is a set of small actions that add up. In 2016, the US dollar represented roughly 65% of global foreign exchange reserves. By 2024, that number had fallen to around 59%. By 2025, it was roughly 57%. That may not sound like a collapse. It is not a collapse, but it is a trend. And in markets, the trend matters because capital moves before the public narrative catches up. For decades, it made sense for countries to hold dollars. The dollar was liquid, it was accepted everywhere, it was backed by the deepest capital markets in the world. It was supported by American military power and by the scale of the American economy. But after the United States froze Russia's foreign reserves following the invasion of Ukraine, many countries that were not close American allies saw something very clearly. They saw that reserves are not just assets, they are also political instruments. They asked themselves a simple question: if this can happen to Russia, could it happen to us? That question changed behavior. Countries began diversifying into gold. They began holding more of each other's currencies. They began testing payment systems that do not have to move through the dollar infrastructure. They began doing what smart actors do when they recognize a concentration risk. They did not necessarily abandon the system. They reduced dependence on it. That is the key. You do not have to replace the dollar completely to weaken the dollar's position. You only have to use it less. China is a good example of how this works. In 2010, China held roughly 40% of its reserves in U.S. treasuries. By 2025, that share had fallen to roughly half that level. That is a significant behavioral change. China also developed its cross-border interbank payment system known as CACs to facilitate transactions in yuan. It is not replacing the dollar system tomorrow. It does not need to. Its importance is that it gives countries another rail, another option, another way to reduce dependence on the dollar-based system. Other mechanisms are developing at the same time. Some countries are increasingly settling trade bilaterally in their own currencies rather than first converting through dollars. This is happening in different forms among countries such as China, India, and Russia. Central banks have also been buying gold aggressively because gold is seen as a neutral asset. It is not someone else's liability. It cannot be printed by a central bank. It is not controlled by a single government. Sanctions regime. Then there are new payment platforms being discussed and tested among BRICS countries, including systems designed to allow trade in local currencies without relying on the traditional Western. Controlled messaging and settlement infrastructure. There are also experiments such as mBridge, a blockchain-based framework tested by central banks in places such as China, Hong Kong, Thailand, the UAE, and Saudi Arabia. The goal is to allow central banks to settle digital payments without needing the United States or another neutral third party to sit in the middle. There are even proposals for new settlement units backed partly by gold and partly by a basket of BRICS currencies. Some of these systems may fail, some may take a long time, some may remain small, but that is not the point. The point is that the direction is clear. The world is building redundancy around the dollar. That is what big systems do when they believe the center has become risky. When a bridge is the only bridge, everybody has to cross it. When several bridges are built, even if the old bridge remains the largest and strongest, its monopoly power has changed. That is the world investors must now understand. The question is not whether the US dollar remains important. It does. The question is whether it remains as dominant as it was when most American portfolios were built, around the assumption that US dominance was permanent. That is a different question, and it has very different investment implications. The second major shift is global diversification. Many people focus entirely on China because China is the obvious challenger to the United States. Goldman Sachs and others have projected that China could overtake the United States in economic size in the coming decade. But the deeper story is bigger than China. India is one of the most important pieces of this system. India's population is large, young, growing, and increasingly technologically capable. Forecasts suggest that India could become one of the world's next $10 trillion economies. If that happens, it changes global consumption, technology demand, commodity demand, capital flows, and equity market composition. And when you zoom out further, emerging markets as a group are expected to represent a much larger share of the global stock market over the coming decades than they do today. That is a structural shift right now. Many American investors are overwhelmingly concentrated in U.S. markets. That made sense for the last 50 years. The United States was the most profitable, most innovative, most liquid, and most trusted market in the world. But a decision that made sense in one environment can become a hidden risk in another. That is how cycles work. The same allocation that protected you in one world can expose you in the next world. Major institutions have started adjusting their long-term expectations. Vanguard has projected U.S. stocks to return in the single digits annually over the next decade, while expecting international markets to do somewhat better. J.P. Morgan has been more constructive on emerging markets. Fidelity has also projected stronger long-term growth outside the United States over a longer horizon. The exact numbers matter less than the alignment. When different institutions using different models begin pointing in the same direction, I pay attention. It does not mean they will be right. Forecasts are not certainties, but they are signals. And the signal is that the next decade may not look like the last decade. That is very important because many investors are psychologically anchored to the returns of the last 10 or 20 years. They believe that what just worked will continue working in the same way. They believe that the biggest American companies will remain the best place to put almost every dollar that may happen. But a good investor does not build a portfolio around only one outcome. A good investor builds a portfolio that can survive and benefit across multiple plausible outcomes. This is where concentration risk becomes important. The top 10 companies now represent roughly 40% of the S&P 500. That means many investors who think they own a broad market index are actually much more concentrated than they realize. They believe they own 500 companies. In practice, a very large portion of their money is tied to a small number of enormous companies. Those companies are great businesses. They have scale, they have profits, they have innovation. They have network effects, they have cash flow, they may continue to do very well, but concentration is still concentration. When an index becomes heavily dependent on a small group of companies, the investor must ask whether they are being paid enough for that risk. At the same time, a weakening dollar changes the math for foreign assets. If a foreign stock earns the same amount in its local currency, but the dollar weakens, the U.S. investor can receive a higher return when those earnings are translated back into dollars. That is why currency matters. Currency is not just something traders speculate on. It is part of your real return. If you live in dollars, spend in dollars, and invest only in dollar assets, you are making an implicit bet that the dollar will preserve enough of its purchasing power and global position for your portfolio to meet your long-term needs. That bet may still work, but it is a bet, and most people do not even know they are making it. Now, it is also important to be balanced. The dollar has problems, but the dollar still has enormous strengths. This is where many people get the story wrong. They see the decline in dollar reserves, then they jump to collapse. They see China building payment rails, then they jump to replacement. They see gold buying, then they jump to the end of the dollar system. That is not how I see it. The dollar is weakening in relative terms, but it remains deeply embedded in the global system. There is still no clean replacement. Europe has political fragmentation and debt issues. China has capital controls, which make the yuan difficult to use as a reserve currency. In the same way, gold cannot be sent across borders in real time to settle modern financial obligations. Bitcoin may be useful for certain kinds of diversification, but it has been too volatile to serve as the primary short-term reserve asset of the world. The United States still has the deepest and most liquid capital markets. It still has a very powerful military. It still has the leading technology ecosystem in artificial intelligence, semiconductors, and biotechnology. In crises, capital still often flows into the United States, not away from it. The dollar is still used in a very large share of foreign exchange transactions. It still represents a very large share of global payments. Even many alternative systems still interact with dollar infrastructure in practice. So I do not see this as a dollar collapse story. I see it as a dollar dilution story. The United States is moving from being the single overwhelming center of the global financial order toward being one of several major centers. That is a very different world. It can take decades, it can happen slowly, but if you wait until it is obvious to everybody, the easy adjustment may already be gone. That is why investors need to think in probabilities, not slogans. One possible future is that the United States continues to dominate because its innovation engine remains unmatched. Another possible future is that the United States still performs well, but international markets and emerging markets perform better because they started from lower valuations and had more room to grow. Another possible future is that the dollar weakens steadily and real assets become more important. Another possible future is that geopolitical conflict causes supply shocks, inflation pressures, and commodity cycles that force investors to own different types of assets than they owned during the age of easy globalization. A resilient portfolio does not have to predict the exact future. It has to avoid being destroyed by a future that differs from the past. That is the principle. If I were thinking about how to respond to this environment, I would not start with panic. I would start with diversification. The first question is whether you are too concentrated in one country. If almost all of your investments are in the United States, then you are implicitly betting that the United States will remain the best performing and most dominant market indefinitely. That may be right, but it is not guaranteed, and because the world is getting broader, not narrower, I believe there is a strong argument for owning some exposure to other countries. That does not mean abandoning the United States. It means recognizing that the world has more than one engine of growth. The second area is emerging markets, when major institutions independently conclude that international and emerging market stocks look more attractive on valuation and long-term growth grounds. I do not treat that as a command. I treat it as useful evidence. A simple international index fund can be enough for many investors. The point is not to become a specialist in every country. The point is to stop building a portfolio as though one country is the only country that matters. Emerging markets can be volatile, they can have political risk, they can have currency risk, they can disappoint for long periods, but they can also benefit from demographics, productivity catch-up, urbanization, technology adoption, and lower starting valuations. Those are powerful long-term forces. The third area is precious metals. I have never believed that gold should be treated as a magical asset that solves every problem. It does not produce cash flow, it does not innovate, it does not compound internally the way a good business does. But gold plays a different role. Gold is a hedge against certain kinds of monetary and political risk. When central banks are buying gold at the fastest pace in decades, the reasoning is not mysterious. They are buying something that no government can print and that no other country can easily sanction away. For an investor, that does not mean going all in on gold. It means asking whether a small allocation has a role in a world where debt, currency dilution, and reserve diversification are all part of the system. The fourth area is commodities. The world still runs on physical inputs. Oil, metals, copper, food, and other commodities are not abstractions. They are the materials of growth. If emerging markets grow, they need more of those inputs. If supply chains become less efficient because of geopolitical conflict, commodities can become more valuable. If the dollar weakens, commodities priced globally can rise in dollar terms. If inflation remains a problem, commodities can help provide some insulation. That does not mean you chase every commodity spike. Commodity markets are cyclical and can punish late buyers. But as part of a diversified strategy in a changing world order, real assets deserve attention. The fifth point is the one that often gets lost in fear-driven narratives. Do not abandon the United States. The United States still has extraordinary strengths. It still has the world's deepest capital markets. It still has the best innovation ecosystems in many of the most important industries. It still has companies with global reach, strong margins, and enormous competitive advantages. Even if future U.S. stock returns are lower than the last 20 years. Lower does not mean bad. The issue is not whether the United States should be owned, it should. The issue is whether it should be the only meaningful thing you own. That is the difference between confidence and overconfidence. Confidence says the United States remains strong. Overconfidence says nothing else matters. The investor who survives big transitions avoids overconfidence. They ask what could go wrong. They ask what the other side of the trade looks like. They ask whether they are prepared for a world in which the dominant power remains dominant, and also for a world in which the dominant power slowly loses share. This is why I believe the opportunity is not in panic, but in positioning. If the dollar remains strong and the United States continues to dominate, a diversified investor can still benefit from U.S. exposure. If the dollar weakens and emerging markets outperform, a diversified investor has exposure there too. If commodities and precious metals become more important, a diversified investor has some protection. If international equities benefit from lower valuations and stronger growth, a diversified investor participates. The goal is not to be perfectly right. The goal is to not be dangerously wrong. That is one of the most important principles in investing. Most people try to win by finding the single best answer. The better way is often to build a system that works across several reasonable answers. When I look at the global system today, I see a world that is no longer organized around one unquestioned center. I see a dollar that remains powerful but is losing some share. I see countries that want to reduce dependence on U.S. financial infrastructure. I see central banks accumulating gold. I see payment systems being built outside the old rails. I see emerging markets becoming a larger part of global growth. I see India rising. I see China pushing for greater financial independence. I see American companies still leading in critical technologies. I see US markets still strong, but expensive and concentrated. I see investors who are heavily exposed to the assumptions of the last world order. And I see an opportunity for those willing to adapt before the adaptation becomes obvious. That is what this is really about. It is not about hating the dollar. It is not about betting against America. It is not about believing that China or any other country will simply replace the United States in a clean, simple, one-for-one way. History is rarely that neat. It is about understanding that power shifts are messy. They create winners and losers. They create volatility. They create inflation pressures. They create new capital flows. They reward investors who look at the whole system rather than the last chart that went up. Most investors will not do that. They will stay concentrated because concentration worked. They will dismiss international markets because US markets dominated. They will ignore currency risk because the dollar always felt safe. They will ignore gold because it did not matter as much during the technology-led boom. They will ignore commodities because they are difficult and cyclical. They will ignore emerging markets because they are volatile. And then, if the world changes faster than they expected, they will ask why their portfolio was not prepared. Preparation is easier before the crisis. That is true in markets, in life, in business, and in countries. You do not build a bridge after the river floods. You build it while the weather is still calm enough to work. This is the moment to think clearly, not emotionally, not politically, not ideologically, systemically. Ask what the machine is doing. The machine is showing that the United States remains powerful but less singular. The machine is showing that the dollar remains central but less uncontested. The machine is showing that emerging markets are becoming too large to ignore. The machine is showing that real assets have a renewed role in a debt-heavy, inflation-sensitive world. The machine is showing that the next decade may not reward the same portfolio that the last decade rewarded. That is the lesson. The people who do best in large transitions are not necessarily the ones with the most complicated strategies. They are the ones who understand the direction of the flow and make small rational adjustments early. They do not need to predict the exact year China grows larger than the United States. They do not need to know exactly when India becomes the third great economic engine. They do not need to know whether the dollar reserve share falls from 57% to 50% or stabilizes for a while. They do not need to know which payment system becomes dominant. They simply need to understand that the old monopoly is weakening. The world is diversifying, and their portfolio should not be built as though nothing has changed. That is a very different mindset from trying to time markets. Market timing asks what will happen next month. System thinking asks what forces are changing the next decade. Market timing creates stress. System thinking creates preparation, and preparation done correctly creates options. If the United States keeps leading, you have exposure. If emerging markets rise, you have exposure. If the dollar weakens, you have exposure to assets that may benefit. If commodities become more important, you have some insulation. If gold continues to serve as a neutral reserve asset, you have a hedge. If nothing dramatic happens, you still own a more balanced portfolio. That is how I would think about it. Not as a prediction, as a risk, balanced response to a changing world order. Because the reality is simple. The world is getting bigger, capital is moving to more places, growth is becoming more distributed. Payment systems are becoming more fragmented. Countries are becoming more strategic about what they hold and how they trade. And investors who recognize that early may have one of the most important opportunities of the next decade, but only if they stay rational. The danger is not just being too complacent. The danger is also being too extreme. Some people will hear this story and decide the dollar is finished tomorrow. That is not rational. Some people will hear this story and decide the United States no longer matters. That is also not rational. Some people will hear this story and buy only gold, only crypto, only emerging markets, or only commodities. That is not preparation. That is a different kind of concentration. The right approach is more balanced. Keep what still works, add what the new world requires. Reduce the risk of being dependent on a single country, a single currency, a single market, and a single historical assumption. That is the principle. A changing world order does not mean the end of opportunity. It means the opportunity moves. It means the risks move. It means the capital flows move. And when capital flows move, the investors who understand the movement are positioned before others are forced to react. The United States dollar is not disappearing, but the world that treated the dollar as the only serious center of gravity is changing. China is not guaranteed to dominate the future, but China has already changed the bargaining power of the system. India is not guaranteed to deliver a straight line of growth, But India's size, demographics, and technological adoption are too important to ignore. Emerging markets will not rise without volatility, but volatility is not the same thing as lack of opportunity. Gold will not solve every problem, but it can protect against a problem that printed money cannot solve. Commodities will not compound like great companies, but the world cannot function without them. The U.S. market may still be the best market in many ways, but even the best market can become risky if everybody owns it at the same time. At high valuations with the same assumptions, that is the reality. So do not panic, do not become ideological, do not assume that the past decade is a permanent law of nature. Look at the system, look at the debt, look at the currency trends, look at the reserve behavior, look at the payment systems, look at where populations are growing, look at where valuations are lower, look at where central banks are putting their own protection, look at where the big institutions are changing their long-term return expectations, then ask whether your portfolio reflects that reality. If it does not, the adjustment does not have to be dramatic. Small changes made early can matter more than large changes made too late. That is how wealth is protected. That is how wealth is built. Not by reacting to every headline, but by understanding the larger pattern before it becomes obvious to everyone. The next decade may be very different from the last one. The best investors will not be the ones who predicted every detail correctly. They will be the ones who understood that the world order was changing, prepared for more than one outcome, stayed flexible, and let time work for them. That is the opportunity. And in a world where the dollar is being diluted, emerging markets are rising, central banks are diversifying, and the United States remains powerful but no longer alone, that opportunity may be one of the most important of the next decade.